Hey folks, it's Adrian CryptoBurb speaking. Welcome to today's Friday webinar. This is the last webinar of 2022. We're going to review actually 2022 in charts. We're going to have a look at have a little deeper consideration for what potentially may be coming ahead, and basically they're right around the corner. We're going to talk about a recession. If you guys want to, hear this and more, make sure to stay tuned. We are heading to the last webinar of 2022 right in a second. Welcome. How is everybody doing? This is Adrian CryptoBurb talking to you straight from my beautiful office. And this is the last and the only webinar that you're going to have until 2022 ends. From me, and this has been year full of surprises. That's the best way I would definitely, just kind of like reframe to it after the years in hindsight. I got many surprises, and this year was definitely full of surprises. It was not only about the war, it was not only about some galloping inflation, which is extremely hard to be tamed, but then also, of course, it was all coming up with the entire year focused on fighting down the inflation, tackling down inflation, and at the same time, as a result, triggering the recession signals. Well, let me know, guys, if you want, I'm reading nice comments. Have a great new year, bro, and the Burp family. All the best love to you, Amir. Plan Zero is saying happy Bulls year 2023. I think it's going to be finally Bulls year. This definitely wasn't a bull year this year. This year, in fact, was the very 180-degree opposite case of the bullish year, because we only looked for the entire time, we only looked to the downside, and the bearish market tendencies were the ones that prevailed and the ones that dominated the entire market scene. And we all know that the markets tend to lead the economy, the markets tend to lead the economic cycle, and as a result, if the markets fall like a falling knife and then a completely free fall off the cliff, and there is no stopping to the downside anywhere on the way, then then this is definitely what not only slows economy, but at certain occasions it definitely triggers recession. So hope you guys are going to have really cool celebration. There's definitely some interesting topics to be covered. Let me know how you are doing in the comments, and if you're watching that on YouTube, make sure you hit the subscribe button, smash the notification bell, and hit the likes as well, so that you stay all over notified, because we've got so much for you coming up in 2023. Before that, let's have a look at 2022. So first of all, we've been looking at this overall market summary from the perspective of the stock market. This is the chart of Dow Jones Industrials, and at the bottom of Dow Jones Transportation Average. And both, ever since the year started, we're basically moving in this descending trajectory, in this descending, mode, regime, if you will, which is nothing different than what we call the bear market, the bearish market, which kind of like continues to make lower highs and lower lows on a consequent consecutive basis. And now this is how we know that this is in a bear market, right? Another way to know that this year had been entirely about the bear, is by observing the averages. This blue curve is actually what we refer to as the 200-day average, and this 200-day average is basically representing the overalls of the descending regime, declining regime of of what we know as the bearish trends. As simple as that, right? I can see, I'm just looking at right now at the feedback on my phone, and I can see that for some reason the screen is not really highlighting the drawings that I'm making. So I'm going to try to make some visualizations this way. Bear with me. So here, of course, like I said, we're looking at this overall declining tendency for the entirety of the year. There are definitely a lot of headwinds going on. Not only the economy slowing, which kind of like was also coming from this overly reactive, I should say, overly aggressive way of printing money to tackle down COVID. First, we of course got this COVID crisis, which required a lot of economic slowdown, close downs, and this was definitely a short recession, which then, as a result, required, or I should say, made politicians, the monetary politicians, decide about very aggressive monetary expansion and very aggressive, um, where overall printing, let's be honest, the biggest amount of money ever printed was printed in during 2022 2020 2021. This is the real world we are talking. This is 30% of ever printed money was printed in 2020. And well, this had to come with its consequences, and the consequences is what we are having right now, is what we are feeling exactly right now. The fact that people are starting to lose the jobs, the fact that the overall fact that people are, starting to see their, well, and notice if they are actually bigger, greater misery in terms of the finances, in terms of how difficult that is to operate as a business, how the inflation costs, were definitely not really accompanied by proportionate increase in wages, and this all kind of like deteriorated the overall economic conditions. And as a result, it only reinforced the bear market conditions. And these bear market conditions, overall, again, in turn, empowered the bear market, and the bear market empowered even more the economic crisis. So this is a very, very dangerous, feedback, very positive feedback, when one effect puts well have it has even stronger impact on than another one on what's coming, and it's kind of like self-fulfilling to a larger extent. So by observing the averages, this 200-day average, it was no actual reason to claim against that we were in the bear market. And even if you connect the simple trend lines, then what you're looking at is a consequent decline in terms of connecting the peaks. And whenever those peaks kind of like continue to decline, in this kind of like a descending sequence, then this is what we know, that that the market is really turning down. And this has been the reality for the past year, ever since November 8th. Actually, last year, we were looking at the peaks in the market territory, and those peaks, in the S&P 500 and cryptos, were all coming together uh, to form a massive global inflection. The problem with the economy these days and with the markets is that it's very globalized. It means that one major market, such as the United States, is basically impacting like a domino puzzle, all of the other markets. One is so dependent on another that it kind of like becomes interconnected. And when one market crashes, when one economy crashes, the other ones are likely to follow because of those very tight connections. This is this is very interesting from the statistical perspective, from this overall, I should say, political perspective, crisis management, and of course financially, and it brings so many other perspectives that definitely should be reconsidered in terms of not only just your finances. However, the good news is that for the first time, this 2022 brought this massive upwards shot. Yeah, this massive upwards, just push was coming, because basically we were looking at this upside pullback ever since October, kind of like rallied, off the lows. We were looking at a little bit of a fake bottom there, or a double bottom pattern, being a result of a fake breakout to the downside. Typically when you see a breakout that just comes and tests many different times, that set a support level, and when it breaks, typically you would assume that it's bearish, because in reality it is. However, when the market is already overextended and it's kind of like the trend is exhausted, it's lasted for a long time, then this is what typically would suggest that you should beware of the fake breakouts, because it would trick you into thinking that the market is continuing lower. However, when it pulls back above the broken level, above the broken support, and it kind of like establishes trading back above this level, then this is typically what kind of like corresponds and brings this overall reversal in a sharper V-shaped manner, if you will, this sharper retracement, pullback, upwards recovery, whatever you name that. And this is the actual case what we were looking at. So if we are again to notice something positive above this chart, is that the damage is done in terms of the stock prices. The damage is done. The bear market is done. Well, of course, it's still not out of the woods, right? All that I'm saying is that if you see and if you look at his charts, there is a little bit, there is a little bit of a glimmer of hope, if you will, light at the end of a tunnel, because not only for the first time we got to see this technical strength as the market, turned up over the trend line, over this bear market trend line, but it also again just flattened out. If you see the directions of the 200-day curve, of the 200-day average, then the 200-day average trajectory is not declining, it's not descending anymore, it's flat. So what it tells me is that this most likely, proved to be the bottom. The Octobers actually, historically, over the 125 years of data, is what we are looking at when we are expecting the reversals. So Dow Jones Industrials, basically over the 125 years of data, of sample, 125 years. This is a lot. This is not some kind of like, some gimmicks, one trick ponies. This is 125 years of sample of data, of historical records. And you can tell, you can do, well, you can really tell that the most, if you look at this, right hand side, where I'm highlighting the dates, this is the end moments of the finishing moments of October that typically the market seasonally bottoms out. Well, and like I said, having September being the worst month per average by month, then seasonality often favors that October is typically when we see the cyclical troughs. So here this time we actually got to see a little bit of confirmation. Like I said, it's not a it's not a secret anymore. Of course, everything is obvious in hindsight. However, what we know by studying seasonality patterns, especially over the larger sample, like 125 years, is that those patterns tend to prevail. Those patterns are the dominant tendencies. So it means that over the time, over those 125 years, it happens more often than not. So it means that it sets your expectations right. So if you know that seasonally the bottoms of the stock markets occur in October, then it would be unwise to assume against. So knowing of those kind of like, again, curve of this 200-day curve that it's already flattened out, this is positive. Of course, we've seen this massive upwards breakout, then a little bit of a pullback, mean reversion, so-called, back to the 100-day trend. However, what I like so far about this one is that it's trading above it. That it's trading above it ever since November's breakout. Since November's breakout, we're looking at this massive break. That's pretty cool. Let me know real quick if you can hear me, if you can see me well still, if everything is clear, what I'm sharing, because there are definitely lots of auto charts coming. But what we know so far is that 2022 was the midterm elections year, and historically over the past 75 years or 70 years plus, well, the midterm election years are typically bearish, are not bullish, which means that they either return negative results or sideways. So one way or another, it was not bullish, and this just proved to be yet another case of it. So then, like I said, what we're looking at, if we move to the left-hand side, then, well, typically you can tell that over the 125 years, Dow Jones and stocks, the top capitalization, stocks per the American economy, they typically rally and continue something that we know as a Santa Claus rally into the first days of January, when it typically marks its peak, and seasonally it kind of like continues to descend. It continues to descend into February. So I would argue that, again, this is something that you should be prepared for. This is not something that is a guarantee, okay, that just because 125 years basically happened, and it's repeated this pattern. This is an averaged out data. But because the sample is large, the average, the mean of the sample is a good measure and a good estimate of expectations. So it's good to set the expectations, not because they're going to be certain, but because you have to have your reference point to know what's wrong or what's right, to know when you succeed or when you fail. So having this anchor is definitely helpful. And there, knowing that January typically, again, starts off nicely but ends in turn negatively, or barely on the positive note, positive tune, then it often moves into declines in February. Yeah, so this is, again, something that you should not necessarily assume against it. So it's good to know that. Uh, if we go and have a look at the energy sector, then what we're looking at the in terms of the energy sector, I hope you guys are going to be able to see it. Well, then we were looking at this entire fraction ever from 2022 started. Yeah, so 2022 was the whole increase of an energy sector, the whole increase of the energy prices, which were continuing to climb up. Um, and we're not really seeing any sort of like slowing to it. And I would argue that we're still not seeing a lot of slowing signals. In fact, we are looking at continuation patterns. Of course, there's a little bit of technical weakness there on top, mainly because, well, I would argue that we're looking at a little bit of a fake out there on top. So this fake out makes me think, fuck up, fake out, whatever you frame that. This makes me think that, well, I would argue that this may be just a hint from the market itself organically that traders are exhausted with the high energy prices. So this means they start to disbelieve that a little bit. They start suffering maybe just from a little bit of a cognitive dissonance when the market turns down, which kind of like again just triggers all of those reversal patterns eventually. But what matters is that we're still on average moving in a strong 200-day trend. Strong ascending 200-day trend tells me this is a bull market. And when it's, well, as long as it's a bull market and as long as this 200-day trend continues to ascend, I would argue that it's not safe to assume against it just again. Yeah, so despite there is a little bit of the reversal signals of that exhaustion of the distribution after long upwards trend following many bullish patterns, breakouts and overall sideways, even this recent triangle, this tells me that the more patterns you see on the way up, typically, well, the closer you are to the peak, and you're getting those exhaustion signals, but it's too early to say and to confirm that, hey, energy prices are going to, well, just basically go back to normal. It's far from being normal. The inflation is still very high. The energy prices is what drives the inflation often. So the bull market ever since 2022 started has been present on the energy sector side. This has been the best performing market. In fact, if we go to see the performance chart for the S&P 500 sectors, then what we're going to have a look at, well, ever since 2022 started, let's have a look year-to-date data approximately. Then, well, the upper side of the chart tells you that this is 65% almost returns on the early basis year to date for the energy, and the rest of the market, the rest of the sectors, the rest of the stocks are barely break even or underwater. Some of those, like communication services, are 40%, 40, that's 40 on the negative, uh, on the early performance basis. So this makes you think this is not sign of strength. This is sign of weakness. So if the entire market on the stock side, which drives the economic cycles, have been so weak, the stock market has been so weak overall, except for the energy, then, well, just maybe, like I said, we are looking at the damage that is already done. So, well, the question is how much longer it's going to last. The euro dollar there was definitely something that, well, I think was very interesting because, well, this is of course a long-term chart. This is long-term chart that shows that ever since 2008 recession and then crisis, it continued to decline, and there was of course this overall increasing strength of dollar against euro, which of course comes up with euro dollar just declining, euro against dollar. But recently, we were looking at a little bit of an increase and an incline ever since 2022, kind of like again brought this this truth in. So what I'm sharing and what I'm thinking, is that the dollar, of course, had a lot of strength, a lot of technical reason to incline, and it was showing a lot of strength. Of course, we're going to have a look at a dollar chart in a second, and the euro was definitely the one that was lagging, was down, the one that was worse. We know there is a little bit of lag between behind the dollar for the euro. So typically, when the you know eurozone kind of like acts and reacts to what the U.S. economy does, and not the other way around so much. But what it tells me that this euro dollar kind of like directions showing some sort of like a strength, uh, well, in the last couple of months. Then, well, despite it's right there at the local resistance, I would argue here at 1.7, then this may have reversed the overall conditions locally, at least. So this would speak in favor of dollar decrease and euro increase. Then, if we are to study, how the conditions have changed overall for the relative basis, for the RRG chart, for the relative rotation graph, then as I mentioned many times, on the left hand side, on the vertical scale, what you're looking at is the JDK RS momentum. It's the relative strength momentum, or RO change, rate of change, ROC, of the relative strength. Relative strength means this is a price action of one security divided by price of another security. This is kind of like a compared relative analysis, and it puts all the sectors in one point. So here you're looking at definitely at the very 100 and 100 interception right there in the very middle. This interception crossing is where we have the S&P 500, and this is our basis, this is our reference point, and anything that is basically referred to it in a relative basis is going to be listed either in the leading quadrant on the top right, right hand side, or the left, or the left hand side basically is showing that on the top corner, the improving, the lagging in the bottom, and the weakening on the far right bottom. So those stock sectors, typically, again, they tend to move. So we can see this market rotation not only in real time, but also kind of like over the time. So we can tell that this, as the bear market continued, as you see in the upper right corner, this tiny little window, then as I move to the right through the months, through the weeks, then you can see this market rotation. Basically, when one asset class, like utilities, are kind of like going into the leading quadrant, and then they are moving this one. And then they are moving, let me actually just show it to you maybe. It's going to show off the very right, far extreme right, XLU, which is the utilities, which is defensive stocks, again, which is typically what gains a lot of attention from traders and increases the demand whenever the conditions are tough and the traders are feeling unsafe. This is like a little bit of a safe haven for stocks. And you can tell that as we move and proceed for the market to rotate, then the energy are through the roof. The energy sector is through the roof, kind of like moving into the leading quadrant and even beyond. And well, the utilities right now on the far right, upper green corner for the leading quadrant, is basically kind of like just held tilting down, and you can see it travel into the weakening quadrant, and then kind of like just still in the weakening, kind of like continuing there, changing, rotating to the lagging quadrant. So you can tell that there has been rotation entirely for how the energy prices basically continue to incline relatively to S&P 500, and then only for the other defensive stocks to kind of like spend a lot of time in the leading quadrant as well. Defensive like consumer staples, like defensive XLU, like healthcare. This is what typically brings a lot of stability when the situation is tough, and traders are attracted and to park their money in the stable companies that pay out often dividends, and well, that are more about value than growth. So here again, where we are at right now, ever since that 2022 started, is of course a lot of the decline in the within the bear market of the main S&P 500, which drives the economic cycles as well. But right now we are looking at this post damage picture, and this post damage picture is telling me that the energy is still in the leading quadrant, the basic materials are in the leading quadrant. On the XLB side, XLI, which is the industrial quadrant as well, industrial sector at Spider ETF. Then financials, XLV, which is healthcare, and XLP, which is consumer staples. So those defensive and a little bit of industrial is what we're looking at to be leading. And leading means outperforming S&P 500, trading in relative uptrend. So it's better to technically park money in uptrending relatively assets because of the momentum principle. We know that the outperforming assets are more likely to continue to outperform rather than to reverse. Because whenever the money kind of like catches in one direction, it's kind of like, it clicks on it on the track. It tends to travel there until the power disappears or it expires. So it doesn't have this tendency to kind of like interrupt the movement. It has this tendency to persist. It's just like this Newtonian dynamics of the second Newtonian law of dynamics, if you will. So as long as there is this force pushing, this money works like a force. As long as this force is existent, it's going to continue to move in this direction. When you erase this force, it's going to eventually cool off, slow down, and just maybe reverse. So the energy sector and industrials tells me that this is post-factum damage picture with the energy prices which are still high, on the stock market basis. We're looking at still the market being positioned kind of like in parking money in the defensive sectors, as well as a little bit of basic materials and industrials. So this is what I would consider the first, again, glimmer of hope in terms of the relative basis, because basic materials and industrials, whenever they start inclining, especially against the S&P 500, whenever they start to outperform, then this is what I think, may give you a little bit of reason to expect something better for the first time. Otherwise, on the lagging quadrant bottom left corner, XLY, which is consumer discretionary. Now we've seen, Tesla crash like crazy over the past months, and it's been nothing good, just spectacular to observe, but it's definitely painful to a lot of investors and Elon Musk himself. I do believe so. Then next to it, we are looking at the XLC, which is communication services, in which I mentioned that overall, 40% year-to-date basis performance is something that doesn't print a lot of optimism. And because they are in the lagging quadrant, this tells me that they are, basically weak. And weakness generates further weakness. Same Newtonian dynamics laws they apply, if you will. So overall, again, it doesn't make much sense to park your money in something that is weak. And in fact, you want to park your money in something that is strong until it loses its strength, and maybe short the opposite side of something that shows weakness. That would be something that we know as the momentum investing or momentum portfolio theory. If we go further, then, we're not going to see the Bitcoin within this current form. Let me open up another chart real quick. This is the one that I wanted to show you. This is a Tesla chart, by the way. This is how Tesla chart looks like. So we're looking still, before I roll into Bitcoin, the Tesla chart is one of the confirmations, for what stands as the, consumer discretionary there. People are not buying cars much, just Tesla cars much, just the way that the chart suggests, arguably. So here, of course, a lot of decline, and this is a 200-week average. This is 200-week average. This is the serious chart, and 200-week breakdown puts Tesla at minus 79%, if I'm not mistaken, on the yearly performance basis. And this is very similar to Bitcoin. Bitcoin is also heavily below its 200-week average, and this is exactly the chart that I wanted to show you. So, this is what we're looking at. Bitcoin is definitely not looking either too much promising. If we go, let me try to find this other chart when it actually just lists all the curves. Hopefully I'm going to be able to find it, but let's see if it's going to show up. Maybe it's just going to be easier this way. So what we're going to do is we're going to add the moving average. That is going to be showing moving average. Simple, that is going to be showing, of course, 200 weeks. And this is, boom, the very same curve that the Tesla chart had. So I hope you can see that. Again, this is the 200-week curve. Tesla chart is fair. Tesla stock is well beyond and below that. And this is similar to what Bitcoin does. Yeah. So we know that typically those 200-week charts are what shows a lot of technical trend from the long-term perspective. This is often, just triggered and empowered, reinforced by fundamental matters, and fundamental value, which for Bitcoin is disinflationary, which is for Bitcoin typically, again, something that builds the scarcity over the time, just like commodities. Um, and here we're looking at the bottom corner, at the bottom right corner, and what we're looking at is the correlation coefficient between Bitcoin and S&P 500. You can tell that after a short travel to the downside, to the negative fields, to the negative correlation coefficient levels, where Bitcoin trades again negatively or differently to S&P 500, to the stocks. Well, it's rallied back. It's rallying back again into the positive mode, with positive correlation coefficient values tell you that those markets tend to be positively correlated, tend to move in the same directions more often than not, or more likely than not. Here it's slightly positive. Of course, it needs to close off the week nicely. It's still not closed. It's going to have a couple of hours to do so. If it does close positively, it's actually, again, just nature is healing, if you will. What it also kind of like looks like to me is, as long as we are looking at, let me get rid of this one. What we're looking at is this kind of like, support level that, of course, at 17,500 was broken to the downside, and this support level was very critical. And so far, we've been seeing, there's nothing but a rejection. There was a little bit of an FOMC anticipation pump, of course, but J. Powell on December 14th, just announced 50 basis point rate hike, while announcing further continued inclines in the interest rate. So this was definitely coming with a lot of empty anticipation that, soon after, as soon as the news was released, kind of like came back lower, and it's trading below the main level of support at 17,500. So this makes me think that, again, we may see a little bit of headwinds, because if there is such a strong correlation with the stocks, and stocks are likely on the 125-year basis to travel to the downside through January and February, then this is what I would argue just should set you a little bit of expectations for protective approach. Let me actually just have a look at the Bitcoin USD again pattern, seasonal pattern, and what you can tell over 12 years is exactly, or very similar seasonal adjustment. So seasonal pattern, seasonal trajectory over the 12 years, but just notice the difference between the sample size. 125 years of the data for the Dow Jones Industrials, and here we're looking at 12 years data. Bitcoin is very, very young when compared to stocks. So of course, take it with a grain of salt. It's not well reinforced by these broad statistics here. However, what we're looking at is typically that after strong October and November and December, strong Q4 closing of the year, we're looking at slightly decreasing tendency in January. So this is this is the same pattern that you're looking at for Dow Jones Industrials. I hope you see this. The left hand side, the peak in January mid, which seems to be strongly correlated with the peak in Bitcoin prices as well. So this tells me that January should be probably in its vast majority of the time, should be considered and expected to be more bearish than bullish. So if anything, I would argue that we may see more headwinds, especially with the recession starting, coming for Bitcoin. And this is something to get you ready. This is something to, be prepared for. So 2022 has contributed to this overall bear market also in stocks, as well as Tesla, as well as Bitcoin itself. So of course, lots of headwinds, lots of not really good reaction from the risk assets, just like Bitcoin, just like other risk aggressive stocks like technology sector, to the inclining dollar prices, which were the answer, of course, to the overall high inflation, high energy prices, which was coming up with the tapering. So all that things concerned, I would say that the majority of the damage seems to be done for 2022 already. That's the way I would frame it. That's the way I would look at it. In the hindsight, probably after some time, when I come back to 2022, when I'm in 2023 and I come back to 2022, then I would probably think of 2022 as more of this bearish market, that most of the action had been done, had been taken, and most of the damage had been already just caused. So I would be, for most of the time, looking positively into 2023. Of course, unless some natural disasters, catastrophes, wars, assassinations, they just all accelerate and merge. And this is not something that you can control. This is not something that you can predict. No charts are going to tell you when the president is going to be assassinated or when Andrew Tate is going to be put in prison. No chart is going to tell you that. Let's be honest, okay? So it's very important to differentiate and distinguish the expectations versus the guarantee. There is no guarantee, but it's good to have expectations. Hope it makes sense to you. Um, as we go further, then what I'm looking at is that Bitcoin, again, even on the shorter term basis, it's still traveling to the downside. And even though the Dow Jones Industrials already flattened out on this curve, it's flattened out on the 200-day curve, 200-day trend. This is a bull market or a bear market trend. So here, the bull market trend is not existed, and in fact, the bear market trend is still looking to the downside. That Dow Jones Industrials has already flattened on its curve. Bitcoin is still traveling lower. It's still traveling south. So with the failed breakout on top, I would argue that again, it's a little bit, it's a little bit not so much promising because those trends tend to continue, but the majority of the time seems to be already done in the bear. So if I were to compare, of course, take it with a grain of salt. This is not something that you should just go crazy about. But if I were to compare where we are at right now, just to help you visualize and picture, what I'm talking about, then us being here after having traveled so much to the downside is what I would argue we are somewhere over here. Of course, we didn't see a breakout, but you can tell that typically whenever there is this downside travel, on the after the bull market, this is of course the representation of the averaged out bear market. This is what we're looking at. Yeah, this is again small sample, so be careful drawing any conclusions. However, what I want to see in order to confirm any sort of like a bullish trend reversal is that this trend, this bear market trend, is broken to the upside. This is what typically breaks this bearish market tendency trajectory, this southern direction. So, if anything, the moment I see the break over $20,000, which seems to be this main point of reference, this main anchor, this main expectation from traders for what the true or fair price of Bitcoin is, then as long as Bitcoin stays below, it's technically a good buying opportunity, right? Of course, everybody's individual situation should be reconsidered, and consulted with your own financial planners and advisors, or made up solely by yourself. This is not some sort of like a financial advice. What I'm saying is that if you look at a technical chart and you look at this kind of like fairly exhausted chart that's traveled so much to the downside, and the only thing it's missing is this upwards pullback that breaks over this 200-day trend, then playing on a mean reversion may cost you a lot. Mean reversion means that you assume that it's going to pull back eventually to its average, which in all honesty, I think it will, right? It's just probably a matter of time until some regulatory pressures come up, or unless. However, the mean reversion assumes that the prices travel outside the averages for quite some time. And this is what constitutes and creates this average. So, assuming for the mean reversion or trading for the mean reversion, being some sort of like a contrarian approach could be a good profitable profitable strategy. However, it doesn't prepare you in case the market goes lower. It may well go lower by the next 50% or something. Yeah, it may well go and deep towards like its technical levels, for which many traders are looking at. There was this descending triangle there, which kind of like brings a lot of technical targets and eyes towards like $10,000-$12,000 area. So I would argue that despite there is a lot of cheap Bitcoin movements right now, cheap prices, low prices, then it doesn't guarantee that the prices cannot get any lower, especially with bearish January historically, and the fact that we're closing we're stepping into recession. So knowing that 2022, ever since it started, was about the bear market. This is where we're at. The entirety of the time we were traveling to the downside ever since we peaked out in November last year, and we've traveled so much We've traveled so much. We are so deep into retracement. We're like 79%, measured from the peak to the trough so far on the drawdown. Historically, we have about 85 to or 80 to 90% of retracements that typically just come up to print in the cyclical troughs for Bitcoin. So whenever it happens, it travels from the peak to the downside. It travels on average 80 to 90%. Yeah. So again, it doesn't guarantee that it's going to do the same, but it's fair to know and acknowledge that it often does it. Because if it does it, if you cannot exclude this option, then why would you not want to get ready in case it happens? So having so much traveled, in the southern direction, and that most of the damage is done, that the stocks are already healing, which is what drives the economy, and the economy kind of like lags 6 to 9 months behind the stock market. I would argue that we may soon start looking at a little bit of bottoming patterns. Yeah. So again, unless some war escalation comes up, you cannot predict that. But assuming that there's no kind of like catastrophe going on, then the charts are going to tell you that as long as you see this first kind of like an early symptom of a market strength for the first time breaking to the upside, it's like this, first spring flowers that you see in the garden whenever the spring starts. So again, it doesn't guarantee there are going to be no freezing nights, but it does tell you that, okay, nature is healing, that there is something, going on, something is changing, the trend is reversing. That is it about. This is exactly what I wanted to tell you about. So, of course, technically, more strength has been, recently on the Ethereum side. However, this has been not so much dominant anymore. If I were to compare, Ethereum versus 200-day trend, you're still looking at around 16% that it needs to travel to the upside in order to catch up. Bitcoin at the same time needs to travel about 20%. So technically, Ethereum is just a little bit slightly stronger than Bitcoin. So it's what makes it a little bit more bullish or a little bit less bearish, in fact, because the market is still traveling to the downside, both on Ethereum, clearly in a 200-day trend, and Bitcoin. So the trends are bound or more likely to continue in this direction rather than expire, rather than reverse. So it's safer to assume there's probably just a little bit more downside as we head into 2023 January. This is what I would say I'm preparing for. And well, speaking of 2023, we are looking at the consequences coming out of 2022 and the consequences of such a deep bear market of inflation at double-digit levels, and so much, oil prices hikes, and overall, war. Then the recession is likely inevitable at this point. I don't know what would have to happen in order to just not have a recession. However, if we have a look, then this is just a little bit of a thread that I proposed about this topic. And the leading indicators, well, typically when you look at the microfinance to gauge on the financial combination with the economic cycles, and then to guess when the stock market may hint a little bit of a reversal of or recession, then I would argue that the leading indicators, just like S&P 500 prices, which still have not recovered, still continue to drive lower. Notice the difference between Dow Jones and S&P 500. It's very slight. However, it's very apparent in the chart. The interest rate spread, which is the yield curve, which is in the deepest inversion ever since 1980s. This is definitely not optimistic. The retail sales and the consumer sentiment continues to decline for the entirety of 2022. So it's also not good, because it often turns self-fulfilling, because if the consumers don't feel safe and certain about spending, they're not going to spend, and as a result, it slows down the economy, cools it off, and may easily put it into recession. Then housing permits, new housing permits are definitely declining at a very, very fast pace. And this typically what hints and signals the recession. And finally, the composite index of all of those 10 different factors to lead the economy, signaling the recession, is flashing the unquestionable recession signal. So despite the economy has been looking somewhat strong as reminders of what had been going on for the past years when the bull market was on, when the economy is strong, the presidential cycles were still elevating the stock prices. There was a lot of printing and so on and so forth. That even though the economy has been somewhat strong and robust, then the signals, the recession signals, cannot be ignored. So even though the recession is not here in terms of its damage, in terms of its effect, then it means it's right around the corner. And when it's around the right corner, it means you're likely to lose your job, you're likely to close down your business, you're likely to still experience a lot of headwinds and a lot of difficulties in terms of your monetary contraction, like having less money, less spending, and so on and so forth. And it does seem so that the per the official conference board indicators and then conclusions, that the economy is likely to head into recession and start around the beginning of 2023 and last through mid-year. This is exactly what I'm sharing. So, well, this is what it is. So, of course, recession may not be full blown out here, but if you know, like recession is like war, which is like what I wrote. If you know that the war is coming, then, well, I think it would be dumb to ignore that. I think it would be dumb to and unwise to not get prepared. Even if there is a slightest chance of recession coming, then it would be unwise financially and business wise not to get ready for it. So if you know and get so many different signals that the economy is heading into recession and the recession is right around the corner in terms of its effect, yeah, then you better act before it comes. Because after it comes, it's already a little too late to plan anything. Don't you think? Then, um, what I would say is that again, just observing the chart like this one, which is the XLY, which is well, the XLY, the consumer discretion, just like Tesla cars and so on, depending, and chosen upon the consumer discretion, um, versus the XLP, which is the kind of like comparison to risk on versus risk off. This tells you about the risk appetite, and whenever it's declining and it's strongly declining, it's at the historical, it's very low levels ever since March 2020, which is where the COVID kind of like blew out. Then, well, it's not positive for the stocks just yet. It means that there is more defensive place in the market, that the traders or investors are pricing in this recession in the charts already, because those trends tend to come up ahead of the changes. The stock market is like this predictor, is like this forecast tool, because traders trade upon futures expectations of what they expect to be in future. If they expect the prices to increase in future, they're going to buy. If they expect the prices in future to decrease, they're going to sell. It doesn't reflect the current state of the things. So this is why it often leads and kind of like pulls the economy up or drags it down. So here, breaking below XLY, which is, well, the relative chart of XLY to XLP, which keeps declining for the last couple of months, below the crucial, essential, critical support level of relative support again, the had been held otherwise, is telling me that it's not positive, that the consumers are not ready to feel good about the economy, and they're pricing in this recession. That's what it tells me. That's what it tells me. And I hope it does make sense. I hope it does make sense. Crypto 101 saying Happy New Year, brother. Happy New Year to you, Crypto 101 as well. Thanks for tuning in, and thanks for watching watching that. And Plan Zero again, great wishes to Happy Bulls Year 2023. Let me repeat, yeah, but this is definitely great wishes. Amir saying have a great New Year, bro, and the Burp family. And this is also to you, Amir. And this is well, you guys are legends. You guys are legends because you're tuning in extremely difficult times, and um, those are very, very dark and difficult times. Really here to try to learn. You're really here to because you want to improve. You want to gain the knowledge to prepare for what's ahead, and this is great. This is really good. Most of your friends have already disappeared from this market, and this is very sad. This is the reality. So yourself being here, you're granting yourself a chance to kick off the 2023 strong. Congratulations to you. And before I go, um, because it's definitely time to wrap the show, I wanted to tell you that we've launched something amazing because we are celebrating the 5 years of the Burp Nest. In 2017, December 27, I started the Burp Nest as this amazing trading community platform that grew over the years and has grown to be one of the leading trade schools probably in the world right now. Well, I'm the only CMT accredited analyst and technician, from my country. There's also, can be just a little bit of validation from the outside that it's not bullshit, that we are here for the years while 99.9% of competitors are running out of money and basically growing and running out of the crypto in the bear markets and the recessions. This is very difficult, and we've been here for 5 years. We've been here for the bulls, for the bears, and we continue to deliver extremely good quality materials for you to learn and to help you get this chance that you deserve to reach out for financial freedom. I do believe that everyone deserves a chance to get the financial freedom. Not everybody's going to use it for sure, but everybody should have an option and a choice. And that's why I launched the giveaway for $500 poll price. So if you guys want to take part in this celebration, there's like almost 700,000 people, almost 800,000 people just seen this tweet. This is pretty cool, went pretty viral. But lots of people that are still here. And if you are here and want to gain a little bit of prizes, then like, retweet, and comment with a simple tweet. And it's actually pinned, on my wall on my Twitter. So feel free to go ahead and rally there. But what I'm saying is that this celebrates big launch. And this big launch is for the first time ever. Never before, we've offered our calls only signature calls only package and given you a chance to sign up for free. You still can sign up. It's not obligatory. It's optional. You can still sign up and literally pay money for it, of course, just like many people had been doing for the past 5 years. However, for the first time ever, to celebrate this special anniversary, the 5th anniversary of the Burp Nest, we've launched this great option. And the only thing you have to do is to go to theburbnest.com. If you go to theburbnest.com, then where you're going to look at is the services, subscriptions, calls only. This is what you're interested in. And if you choose calls only with Bybit, then we have arranged a special deal with our partners, Bybit. And basically, if you follow certain steps, meet certain criteria, some certain, again, just instructions that Bybit provides you with on their website, and then it may grant you 1 month or 4 months or even entire year for free of this access. An entire year, by the way, costs well, if you renew that monthly, it costs almost $1,500. If you just buy once in advance, for entire year ahead, it costs you almost $1,000. And all that I'm saying that is, if you want to sign up and get it for free, then choose calls only with Bybit and just follow the instructions. Here it's all laid out and explained how to start a free subscription with calls only with Bybit. It's going to take you to set up and follow those instructions, and it's as simple as it gets. Guys, this is great. This is great anniversary, great 5th reason to celebrate. The 5 years has been full of surprises, and we've been through the ups, we've been through the downs, we've been through the recessions, we've been through the bear markets, bull markets, sideways, everything. We are still here while 99.9% of other competitors or similar communities basically evaporated. I think it tells you a lot. And even though the markets are tough, that the situation is tough, we continue to develop. And only this year, I gained the CMT accreditation. That is basically the only charter from my country validating my works as the technical analyst, so that you know that whatever I do and share is of high quality, of the highest quality standards, and not to be gotten anywhere else in the world. So that's if you want to go ahead and grab your chance to sign up for free with calls only with Bybit. You can go and do it now on theburbnest.com, subscriptions on the services, calls only, and calls only with Bybit. That's it. Just go ahead and follow the instructions carefully, and you're going to get unlocked and verified for your free membership, even for 1 year, saving you $1,400 or somewhere around 1,000. Well, That's been a lot of knowledge and insight, I guess, for you guys. So I'll let you digest it a little bit. Long story short, bear market has been bearish. The 2022 bear market has been bearish for not only crypto, for many markets, for many people, and for the economy itself. And this was definitely a transitionary year. This was a lot of headwinds that were acting to blow up in at a full pace, and they seem to start harvesting um, well, in the next couple of months as the recession kicks in. We know that despite the economy has been developing strongly over the past couple of years, maybe then the good times seem to be over as the signals come up that the recession is waiting. And if the recession is waiting, you better get ready. And you can get ready with this premium market insights with the calls only free for Bybit. Go ahead, enjoy that, and celebrate your Happy New Year, guys, within 2023. We're opening 2023 strong, and let it be the bull's year indeed. Let it be the year of a bull. God bless you all. The best wishes for you, for your beautiful families. Give yourself a round of applause, everybody, because you are still here and everybody else is basically gone. So, congratulations. Great job. Well done. And I see you guys very soon into the next year. God bless you all. Bye bye.